Hello investors, it's January 4th, 2016. We want to wish everyone a happy new year. I'm Grant, this is Gary. Adam Carlini is our third partner and we are Dynamic Wealth Management. We're excited to get back into the videos. We took a little break there for the holidays. The market does not seem to like 2016 so far. As the first trading day today was very negative, down a couple of percent. But we have high hopes for this upcoming year.
We do. We have some good slides to talk about how the year finished and how the year is starting off. So let's go ahead and move on and jump into things.
All right, welcome back. Let's jump into things. We wanted to start with some upcoming events that we have. So we do our investments for breakfast meeting every 2 weeks. We took a little break there for the holidays, but we're going to start that up again tomorrow, January 5th. That's Tuesday. We'll do that at 9 o'clock a.m. And we will do that again, of course, on January 19th and every 2 weeks until summertime comes around again. That's a very casual meeting. We hold that here in our conference room. We'll have a little breakfast there. Anyone's invited, please come. As far as formal seminars go, we have 2 in January. One will be in Sun City Festival. That'll be on the 14th at 9 o'clock a.m. We'll have a little breakfast. The other will be a dinner seminar in Sun City Grand on January 28th. Well, that'll be at 5 o'clock p.m. Please call us at 623-466-6060 to reserve your spot. We would love to have you to any or all of those events. Now let's walk through our indicator real quickly. Our indicator is still green, and actually this is a little bit of a false indicator. This was as of the end of last week. So today, of course, Monday, January 4th, we have had a big negative day today, down a couple percent. So it's drug us back down really close to this yellow zone. But again, we only take our signals based on the end of the week close. So hopefully we can get a little bit of a bounce back this week and keep us in this green zone and keep things moving our way for 2016. If the market does fall apart, we'll see ourselves in this yellow zone quickly, as we don't have much cushion there. A couple, really just one key economic event we want to talk about this week, and that is manufacturing. You'll notice manufacturing really has been on a decline over the last year, but specifically over the last few months it's dropped beneath this 50 level, which has shown us a contracting manufacturing picture. So why do we watch that? One reason why we watch manufacturing is it tends to be a canary in the coal mine a little bit. It shows us a little bit of weakness or strength, and you tend to see the stock market follow things like that. It's not guaranteed that when we see this move down, the market will move down with it, but it does give us one more indicator to watch. So with that being said, we'll turn some time over to Gary, and he'll walk us through the stock market.
All right, good to be with you as we start the brand new year. Let's go ahead and, before we move into 2016 and talk about what is going on now, let's give you a quick review of what the numbers look like as we closed out the year. So you're looking at a number of different types of asset classes here, and this is brought to us by the good people at Bespoke. We get a lot of good information from them off of their website. But first of all, the stock market. So where did 2015 end up? It ended up being a negative year overall for the market. In fact, the S&P was down 0.8 for the year. The Dow down 2. Really the only index, as you notice the major U.S. indexes, that was up was the NASDAQ, which finished at about 8.34 on the ETF that tracks the NASDAQ 100, which is the triple Qs. But otherwise, all other major U.S. indexes were negative 3-5% for the year. Notice that as far as the different style classes between growth and value, growth actually had a better year in 2015 than did value. So that was interesting to watch. The other thing that was interesting about 2015 is notice dividends. Dividends was down overall more than even the overall S&P 500. So if you owned dividend stocks in general, you actually did worse on a growth basis than did the overall stock market, which was interesting. A lot of folks that we deal with like dividends. because of the payments that are coming through. So that's kind of an interesting thing, that dividends actually got hit a little bit harder. As we go down and look at sectors, notice of the 10 major sectors, there were only 1, 2, 3, 4 that were in the positive. The highest of the 4 was consumer discretionary, consumer staples, healthcare, and technology. The one that let us down the most, that pulled the market down, in fact, was of course energy, down obviously triple digits, 23% down. But you can kind of look through and see, you know, some of those other sectors and how they panned out for the year. How about countries? Well, a lot of mix, but a lot of negative numbers as you go through and look at these countries in alphabetical order. Australia down 14. Brazil was the big loser, down 43, which really got hit because of their commodity-based economy. Even Canada was down 25%. So Japan, one of the few winners, and Italy was also up slightly. So overall, developed countries was down by about 3.4. And emerging markets down about 18%, much more so than the U.S. Market. So relatively speaking, our market held up fairly well when you look across the globe. How about when you look at other asset classes like commodities? Well, oil, as you know, down 45%, natural gas 41%, but all commodity-based investments, at least the major ones, even gold down 10%. How about your bonds, and what did they do? Well, overall bond values slightly down, and with a lot of volatility in interest rates and the interest rate announcement. So that kind of gives you an update on what happened with the markets last year. I thought this was interesting, so we throw this in, and basically this is a chart that looks at the compares this current bull market to all bull markets going back to 1928. And what you're looking at here is those bull markets that were pre-World War II in the light blue, those that were post-World War II, after World War II here. And it compares our current market, bull market, which started back in March of 2009, up to the current period of time. And so we have been in this bull market for some 2,264 days. How does that average out? Well, this red line is the average for bull markets after World War II, which is 1,512. So obviously this is showing us that as far as length is concerned, our bull market has gone over the average time that we've come to expect. How about as far as strength? And how do we define strength? Is percentage. So the average after World War II for bull markets is a gain of about 86% from bottom to top. How about if we look at the average after World War II, is somewhere at right here is the red line at that 86%. Where are we at? Somewhere around 215% from the bottom to our current position. And again, this was given to us by the good people at Bespoke. So kind of interesting as we look at the length and how long this bull market could go on. A lot of talk about whether we are now running out of steam on this bull market finally. So let's take a look at where we are currently. Last 3 days as we closed out 2015 were down days, and today, wow, big down day. In fact, we closed out at about a loss of 1.5% for the S&P 500. Across the board, we saw about a 1.5 to 2 to 2.5% loss on all major indices beginning 2016. So that's one of the reasons why we wanted to get out our video, because 2016 has not started off on a good foot. The only good note on the day was we actually were as low as here, almost 2.5 or 3%. So the market did rally at the close, and only to lose 1.5, which is still a big loss. One of the things to keep in mind is noticed here at the end of the year, volume very low as you would come to expect. A lot of people went out for the holidays and are still getting back. So we'll see where the market goes throughout this week now. We've shown this chart many times. We thought we'd give you an update on it. This is comparing 2014, which is the gray line, to 2011, which is the dark blue line, to 2007, which is the red line. So the current year as compared to a breakdown and continued bull market year, as compared to a breakdown, upswing, and another big breakdown into the bear market. So as we look at and compare time-wise and post all of those years, and we start from their high point and go from there, notice where we are now. We are near what could be finally some clarity. This has been 7 months in the making of a lot of volatility where the market really has not gone anywhere as far as the S&P 500. Hopefully we finally get some clarity. Do we finally break and move trends higher, or does our trend break key levels and finally break down and we get really defensive in here, and then we let the market continue to do its thing? So hopefully we're near the time where we finally get some clarity. Obviously 2015 could be drastically different from either one of these markets. We have no clue, right? But it gives us some sense of ability to get our bearings and kind of understand where we are time-wise, performance-wise, if we can do some comparison between these 2 years, as a lot of people have talked about of late. So our model allocations, as Grant said, we are still in the green zone. You can actually see how we finished out the week. We're actually price-wise closer to here now as we closed out today's date. So far, though, we're still in the green zone. We will move in the yellow zone if it comes to that, and we have to. We will update our model, of course, based on close of Friday. So we're still in the green zone, but we could change that allocation if price continues to deteriorate for this week. As always, we want to remind you that this video and everything we talk about is not in any way a solicitation to buy or sell, just some good information and a way for us to keep in contact with our clients.